Good morning, students. Good morning. Can you all hear me? Can anyone mention whether you can hear? Students, can you all hear me? Please confirm whether you can hear, just to make sure that it's. Good morning, students. Can you all hear me? Yes, thank you. So, my name is K. Shankaramurthy. Right, you may be knowing I have been conducting webinar series for Sri Lanka, and I have been lecturer at IAS for 18 years. So, if you have any questions during the session, please, I think you can communicate via the chat box so that I can help you to understand any of the questions you have. Firstly, I thank CS Sri Lanka for giving me the opportunity to have this pre-scene discussion. At the same time, I need to thank Aruna, Suraj, all the support they have provided throughout even the past and today. So, we will take the pre-scene of your paper, that's December 2022. I believe that everyone is having the pre-scene with your computer or maybe in your hand, the pre-scene printout or the soft copy, so that it is easier, because we are not sharing that in the screen, because I am going to use the whiteboard so that it will be more effective for you to understand some of the things which you are discussing. That's generally I prefer to do. So, can we have the pre-scene with you in your hands so that it is convenient for you to go through. So, just to initial maybe half an hour, I would like to take the case background, strengths, what they have, and what kind of activities, what the group structure, those kind of things we'll discuss, then moving into the further analysis. So, let me, you all, I think it has to be interactive so that you could communicate. Starting with this company's background, it has been started when? 1985. So, I'm sure like you would have seen it, the case starts in 1985, or the company it's in 1985 they have started the organization as the Safeway Holdings Private Limited. That's mainly one retail shop to sell the branded consumer products for the niche market, I would say, niche market. They started in 1985. Then they moved on to 1992. They started a supermarket company that is called Safeway Fresh Mart. Safeway Fresh Mart. Firstly, it was Safeway Holdings. Second, Safeway Food Fresh or Fruit Smart. Sorry? Screen it not shared. Actually, you don't see the pre-scene. That's why I wanted you all to have the pre-scene with you. But board, can you see the board? You can't see the board. Ah, okay. Sorry about it. Just give me a second. Can you all see now? Not yet. If you can see, please inform. Yeah. Can you see now? Now can see? Okay, thank you. So we said the Safeway Holdings PLC, the initial company was started in 1985 as Safeway Holdings Private Limited, mainly to cater to a niche market. There is one outlet they are talking about cinnamon area, branded imported consumer goods to sell it. And 1992 they started a supermarket, actually supermarket company in 1992, and 1998 there are many activities happened in 1998. The company got listed, then they opened outlets, they started opening outlets, and 1998 they started a company called SWMD. So they started a company called SWMD mainly to acquire businesses in a similar line of business, and then they started SWHR. This is actually manufacturing and distribution. These are hotels and restaurants. So there are two companies they incorporated mainly to buy the similar line of business, and second one is to the hotels and restaurants, which are primarily loss making ones they want to buy. So there are two entities they created in 1998, and then they went for IPO in 1998 and they raised the money. To invest in the acquisition whatever they are talking about. So that is, I think the IPO amount was how much? Anyone? IPO, the amount what they were talking is how much? Can you hear me? Yeah, I think maybe your chat box works, right? You can type it. So how much IPO money they raised to buy the companies?
1 billion.
Yeah, 1 billion. So the 1 billion rupees, 1 billion was the amount they raised to buy the companies through these two entities. These two entities they bought it, and in 1998 again they acquired a Kotmale based dairy company. So they bought a dairy company, Kotmale based dairy company in 1998, that is called FMDP, and then they bought FMC. There's another company they bought it, which is actually, what is the products they are selling? FMC? Students? The FMC was what company?
Chocolate manufacturing.
Sorry? Chocolate manufacturing. Exactly. Chocolate manufacturing. Chocolate manufacturing company bought it in 1998. So you could see in 1998 from this group point of view, there are many entities started. These two are the entities, SWMD, SWHR are the entities they incorporated to buy companies in terms of similar line of business or the hotels and restaurants. Then they had two companies they have incorporated, dairy and chocolate based businesses, that is in 1998. Again they bought Coral Beach Negombo, right? Coral Beach in Negombo, a hotel company, and they got franchise from a leading or luxury restaurant, franchise rights. These all happened in 1998. So very important time for the company or the group, 1998. Apart from that, if you look at the background, the company is talking about, in order to support the supermarket business line, they want to have a good supply chain, and they bought some of the farming lands. so that they will be able to get the supply without any problem. Further, they have got into agreements with the farmers so that the supply is continuous. At the same time, they develop the farming community. So these are things they have mentioned. 2017, very close by, right? This is 1998, is almost 25 years back. So if you take 2017, what happened? Can anyone say? 2017, what happened? Anyone? 2017? Yeah, 2017, they went into what business? Mini hydro. Mini hydro. Actually, they, if you really look at the company in the past, they wanted to get into the acquisition strategy, and then buy organization, buy businesses. But I think 2017, first time they say that as per the case, they are breaking that tradition of buying companies, and they wanted to get into what? Mini hydro power. Mini hydro power, how many megawatts they are talking about? Mini hydro power. Mini hydro power, what megawatts they are talking about? Exactly. 1.5 megawatt. 1.5 megawatts, and the amount they invested is how much? 1.5 megawatt, they are invested how much? 250 million. Board is not clear. Board is not clear. Can you see the board properly? Suraj. Not clear. Just please hold. Sorry? I didn't get you. Chat box is there. I think some people are typing. No? Yeah, some students are typing. I can see 250 million. Actually, while we do the MS team, I think that a video also being recorded in order to they have not gone through it, but the hydropower, of course, they have invested. Hydropower has invested. That is in 2017. And when they started the hydropower generation? 2017, they commenced the hydropower construction of the project, and then they started producing electricity from 2019. Exactly. Someone is sharing his screen. That's why screen is. Okay. So 2019, they have actually started producing electricity, 1.5 megawatt. So we will come to that further discussion when we are looking at the segment analysis. As we mentioned, hotel investment has been postponed due to the COVID. Hotel investment has been postponed due to the COVID. 2018, they have invested, or maybe they have developed new technology and smart technology. So that is in 2018. 2021 and 22, that's our year, the last year we are talking for the case. 21, 22. What happened 21, 22? Anybody? Anyone who noted they did what? Any idea?
Acquisition of Minimark chain.
Exactly, very good. Acquisition of Express Smart, right? It's called.
Yes.
Yeah, Express Smart. It's a competitor supermarket chain. How many outlets we have? Sorry? 2 outlets. Is it 2 outlets we are having? Exactly. 2 outlets, no. How many outlets, students? Very good, very good. I think the two outlets, I think when I read it all first, I got the understanding two outlets. I think that is at that paragraph, when you are reading, that paragraph, that two outlets was there at that time. But now if you look at the company, they have how many outlets? 300 outlets and island wide, right? Island wide. All 25 districts, they have outlets. And the Express, this company, the competitor company Expert Mart, we have bought it during the 2022 March. We have finalized the transaction and we have paid the transaction value. That has how many outlets? Expert Mart, how many outlets they have? Students? Can you hear me? Stuck with that. I understand, yeah. How many outlets you all have in the Express Mart? Can you all hear me first, please? How many outlets? Can't hear, right? Can you hear me? Students? Students, can you hear me? Okay. How many outlets the Express Mart has? No, not the I am asking about Express Mart, the company which we are buying. Yeah, exactly. So we should know that we are almost 300 outlets company and we are talking about, we are buying how many outlets? 20 outlets. Okay. So I think that is the transaction value is how much? Anybody? I believe that you have read the case, right? If you have not read it, sorry? Yeah, 711 million. 711 million is the transaction value. They have bought the 20 odd outlets with the properties and the stuff. So they have bought it. So please note that these are just to give you the background, what had happened. Now if you look at it based on these companies buying, right, if you see the companies buying, you will see that the group, now actually is a group which is similar to what group? Anybody? Not the figures and stuff, but some idea if you read the case, what is the case relate to or maybe similar to a business group in Sri Lanka? Anyone? Exactly, Cargill's, right? So you would have seen that many similarities and the businesses what they are in. So it basically relates to them to some extent, but not the numbers and all the strategies and stuff. Okay, now we look at what are strengths this group has. What are strengths this group has? The strengths what the group has. One is they have a history. They started the business in 1985. So they have a history of 1985 onwards. So you should know that generally a company or a group which has have a long existence basically shows their capabilities and their ability to face many challenges, more government changes, policy decision changes, and the taste changes in the marketplace, and the competition and the rules and regulations. So many changes they would have faced it, and still they are surviving and they are doing better and doing good. Seems to be the success story. So that's a main strength group has. It's not just a started company yesterday morning. So it has been there for so many years. So that shows that their ability to face challenges and the uncertainties and come across all the problems and then successfully running the business. So that's one of the strengths there, the history. Second, if you really look at the whole case, when you read it, Stephen, the chairman of the company, they say that he have a very good strategic thinking, and we have a very good vision, mission, and then there are various strategic related aspects they are looking after. So that is showing that company has a direction, and then what they want to achieve in their organization, and they have, more importantly, the stakeholders should be satisfied. Who are the stakeholders they are talking about? These are the first 2-3 pages. If you read the case, strategic, what are the things they are saying? Who are the stakeholders they are satisfying, or they are planning to satisfy over the long period? Employees, one. Customers, I think very importantly customers. Then?
Suppliers.
Exactly, suppliers. In this case, I think they have mentioned the farmers. Farmers community is a larger supplier for most of the products they are supplying. So they wanted to ensure that suppliers are looked after, they grow, they get knowledge, develop their knowledge, and they are looked after in terms of their growth. So there are many aspects they are talking about. Any other stakeholder? Banks and financial institutions who had been supporting the group over the past period, and that they have helped company or the group to acquire many businesses. So that is also important, the financial institution who had been funding this company. And more importantly, the shareholders, that's the primary target. You are trying to maximize the shareholder wealth. So shareholders you are looking after. So other than that, who are other parties they are talking about? I think the community at large, they want to develop knowledge, and they want to develop youth and develop skills for the youth. So there are many aspects. They do it as CSR or a business oriented. They do a lot of things to give the community at large a benefit as an organization. So you would see there are many stakeholders. Why I am talking about it? Because the examiner could be asking the stakeholders of these companies and whether the stakeholders' objectives are looked after by this company. So we should be able to understand that who are the stakeholders, whether your company is working to achieve satisfaction of the stakeholders. And the strengths, when I come to the strategic thinking, I mentioned one, right, very clear vision, and they have direction, and they are trying to buy many companies. More than that, good strength. Can anybody say that? Very good. I think that's very important. They are not dependent on one business. They are diversified. So what are diversified businesses they are in? Starting with the supermarket chain, and they have dairy products manufacturing, and they have restaurants, and they have hydropower recently started, and they have hospitality industry. What else? Chocolate manufacturing. Anything else? Sorry?
Power.
Yeah, power, hydropower. So basically these are the different businesses altogether, even though the primary business is what? What is the primary business? Sorry, I didn't get. What is the primary business of this group?
Retail channel.
Yeah, retail. That is what? Supermarket chain, right? So even though the main business or core business is supermarket chain, we will come to the numbers later, supermarket chain, but they are getting into many businesses. Maybe those are supply chain, there is supply chain organization. So we would have learned under mergers and acquisition. What do you call that, mergers or acquisition? You buying a competitor, Express Mart. You bought a competitor called Express Mart. What is this merger or acquisition?
Vertical integration. Horizontal.
When you combine or when you merge with your competitor or the same industry, what do you call that merger type? Exactly, it's horizontal. But when you go and buy your supplier, for example, the dairy products company and the chocolate manufacturing company, these are what merger? Exactly, vertical. And what even in the vertical, what integration is this? Very good, right? So backward integration. So please note that these are just for your knowledge I am trying to put into your mind, because examiner sometimes when we are asking specially what are the strategies the company has adopted, what kind of merger strategy, whether they are going on a backward integration or forward integration or they are going on horizontal integration. So you should be giving example. They can ask you, give 1 or 2 examples from the case horizontal integration and a vertical integration. Then you should be able to give this example to say Express Smart is a horizontal integration and the dairy products company and the chocolate manufacturing company, your mergers or the acquisition is a backward integration or the vertical integration. So please note these are just to give an idea what kind of strategy you have been adopted in the over the past period. And the hydropower manufacturing not producing and the hotel industry may not be the same line of business of yours. So it's not a vertical, it's not horizontal. What is that? Superb, yeah, that's conglomerate. So please note that that's the conglomerate. It's a conglomerate merger acquisition. So please note that these are just give you an example, because in case the examiner asks you, tell whether the company has adopted backward, horizontal or vertical and give example, 5 marks. So easily you can get this. Basically you know you have identified already from the case what kind of integration or backward or forward or the horizontal or the conglomerate. Then moving on the strengths, they have very good networking, partnership with the farmers, the supply chain. That's a very important strength, because they understand that by doing it they are able to ensure their supply, continuous supply with the farming community, and then price also can be more or less managed, because you can get into a contract, say you get the contract to buy the goods on a longer period at a price reasonably agreed, rather than you go and buy whenever you need, you go and buy, that may be a problem. Then distribution channels, you are not a 1 or 2 outlets company, you have a huge network or distribution channels. Supermarkets are, as I mentioned earlier, how many supermarkets we are talking about? 300 supermarkets. So basically you are a larger distributed organization. Then the technology usage, and then I think the technology usage has been continuously mentioned. So they are involved in developing the technology, they are coming up with app and they want to introduce new technology. So these have been done. So that shows that the organization is having interest to use the technology. That helps in many ways. One is your cost of the transaction comes down, the other one is the productivity increases, third thing that employees are empowered to do more work than going on a traditional basis. Then the young workforce, how many people are working in the organization? How many staff? How many staff this group has? Anyone? Exactly, 5,600 staffs. So the larger people working company, and it's mainly the young workforce. So you can understand supermarkets, you generally get young workforce. So that's a very biggest strength the company has, because they can make use of these people to develop various businesses, and they come with new ideas and they can be productive and energy is there always. So these are the pluses, and then when they are going to new businesses, they have enough human resource, they can be using their talents to develop those businesses also. So those are strengths. Then training institutes, that's a CSR activity, but it's also important because they are able to train more people. Maybe that is for their CSR they do, but that also helps the company on long run by they may be able to absorb the good talent people into the organization. Then the standards, the food production, I think they have talked about many food production. It can be dairy products, it can be chocolate or confectionery items, or even the sausage and the meatball items. So those all food products, they have created a standard, So that's important. Then the brands, you would have seen the brands what they have. They are, even though they are not going in detail, but for a supermarket chain to be successful, right? You would have seen that brands, even whether it's a Cargill's or the Kiehl's, you would have seen it. They have come up with many brands, and the brands are known in the market. So people are very much close to the brands. That's the advantage, because you can be supplying many products into market in the similar brands. So the people will be accepting the brand faster than you basically taking the longer route to establish those products and services. Then the governance. I think there are maybe 2-3 pages you have in the pre-scene which is mainly on to governance related. I believe that is more relevant to what paper? Anybody? Sorry? Yeah, auditing, right? So we don't go into detail about it, but what we understand from the governance related, this company has a very good governance structure. They have all the committees which are required by the stock exchange or the Security Exchange Commission, the listing rules. So they have put all the committee, audit committee, ER committee, all the committees are there in place, and there are many management committees in the company. So that basically shows that their governance point of view, they have a very good governance framework in the organization that helps the company to develop the business in a more transparent and more proper manner. Okay, so those are the strengths. So I again list out the strengths faster. The history, that itself a very good strength, and the strategic vision, mission, and the thinking and the strategies, and the diversified nature of the businesses they are into, networking and partnership with the supply chain or the farmers, distribution channels, 300 outlets, technology usage is increasing, younger worker force, and the training institute for CSR activity, and the standards, food production, they have standards, and they have got enough brands established in the market, and very importantly, the governance structure which helps the company to grow and with more transparency and more compliance. So that basically helps the organization develop. So those are the strengths I would like to say. Then the weaknesses. Anything else on the weaknesses? Your observation? Weaknesses or the problems they are talking about at the moment? Okay, right. I think that is more important for what paper, I think? Fraud is relevant to which paper, I think? Yeah. Financial man, I am talking about business, overall business point of view. What weaknesses you have observed? Very good. So, even though the case doesn't very clearly or emphasize on the issues or the weaknesses the company or the group faces, but then certain problem they are highlighting. One of the problem, they say the company faces working capital issues. So we will come to that in detail. Second, any other problem? If you realize their businesses are mainly, the finance director is talking about it. Yeah, the businesses are more sensitive. If you realize the turnover drop of 2% results in what? A larger impact to their profitability. Do you understand that? The turnover is dropping by say 2%, and they understand that profitability is affected significantly. So what is that? Very good understanding. Operating leverage of this company is low or very high? Operating leverage is the measurement of what risk? Operating leverage and financial leverage. Operating leverage measures what risk? Exactly, business or operational risk. Financial risk is measured by financial leverage. So even here when you see that the final director is saying even a slight drop in the turnover, your profitability is significantly affected, which means you are into higher business risk environment. That means your operating leverage should be very high. So we will discuss little while that. So that is something we have observed already. Further, I think the nature of the business, it's mainly the supermarket, and we are talking about the case from 2021-22 and the past. What happened during our period? This period 21-22 and subsequent period, at least till 22 March, what you observed? Can anyone say that? Macroeconomic picture? Any observation? Sorry? COVID issue was when? When the COVID issue happened? 2009? 2020, for your information, 2020 March we got the COVID in Sri Lanka, 2020 March. And that maybe you would have said 2021, so up to some point we were having here and there. 22, that means 21 April to 22 March, did we very much worry about it? Lockdowns were there? No. Your lockdown was in mainly 2021, right? 21-22 April to March, 22 March, I don't think that is COVID, mainly you are impacted. So what are the other issues at the moment, the country at the moment, macro picture we face? Very high inflation, so you know that high inflation is 60, 70, 80% levels over the past few months we have been observing, but that is actually April onwards it happened to be very high rates, but even before the inflation started. So you can say the high inflation is one observation. What else? A cash flow issue we talked about already. I am talking about the country macroeconomic problems. One is the inflation. Exactly. Your rupee depreciation or devaluation of rupees. What was the rupee against dollar last year, November, December? Anyone? No, last year November, December, what was the $1 equal to rupees?
190 around 190 200.
Yeah, within 200, 190 to 200. And when was the devaluation happen?
In March 2022.
It's a March 2020. It is March 22, not April. Your interest rates were allowed to be increased when? Actually, it's April. It's actually April onwards. I think April first week onwards, the interest rate started to be increasing. This year, 22 April, that is not your financial year. 22 April onwards, interest rate started increasing and the dollar started depreciating from 2022 March. That needs to be known to you very clearly because that is relevant for this case. So what we are looking at here, your higher rupee devaluation and higher inflation and the dollar issue in this country, when did we default the foreign debt? When we sorry? May? No. No, I think it was before that. Right? So we April saying what we are not paying the debt interest, right? Okay. So please note, now these are things you need to be having more knowledge, right? Before you go into the exam day 11th of December, you should be having some knowledge about the macro picture. What I am trying to tell you is because that is relevant. The examiner can ask you because these are the environment related and our subject is financial management. We have to be very clear. When these inflation rates started increasing, when the exchange rate got depreciated severely, we are not talking about 2-3% increase in the depreciation of rupee. We are talking about almost 80%, 90% increase in the rupee depreciation. And inflation is 70-80%. And interest rate which was there like 7%, 6% interest rates became how much? Last year, November, December, what was your 1 year interest rate? Very good. Now, what is the interest rate in Sri Lanka? Yeah, government security. That's supposed to be the risk-free investment, which is basically 30-31%. So please note, these are the present macroeconomic picture. And the taxation, of course, they started increasing on the latter part after 2022 March, but that may not be relevant during that period of the financial we are talking about. But other aspects are definitely having impact to this organization. Right, inflation going up, rupee depreciation, all have an impact on the company businesses. So just keep that in mind for time being. When we come to the financial analysis, we will go in detail. So the issues, when you take these company issues, we take one is the increase, that is inflation. Second, the cash flow problem the company faces, and sensitivity of the businesses. Sensitivity of the businesses, why slighter change in the turnover impact the profitability, okay. And you know that supermarkets purely depend on majority of the people. It's not a niche products. Supermarket sells all the products, right. So the products are catering to various segments of the customers. So the customers' disposable income, when it is reducing, will you increase your sales or it will drop? Customers' disposable income, if it reduces, your sales, the company's sales increases or reduces? Exactly. So when you say the country inflation is going up very much, 60, 70, 80% inflation rates in the country, in that case, as a customer, when you get your salary, you are able to buy the same quantity of goods you bought in the past, or it comes down. So please note that, So the income levels of the people are shrinking in the country. When the income levels of the people are shrinking, or their purchasing power, more than income shrinking, the purchasing power of the income is reducing day by day, then your demand for the normal consumer goods, we are not talking about electronic goods, or we are not talking about vehicles, we are talking here basically basic essential items. Supermarket sells the basic essential food items. So those item demand, what happens? Increase or reduces? Reduces. So keep that in mind. That's the case we are talking about. So when you take the group structure, can you tell me which are the companies under the, say, SWH? SWH is the PLC, right? Safeway Holdings PLC, SWH. SWH, what are the company under that? One is SWFM, which is owned by SWH at what percentage? 80% owned. 20% owned by whom? SWFM, 20% owned by whom? Albert. He is a friend of him, friend of the chairman, right? Both have got educated at the same university. So he owns 20% of this supermarket. That's the main business of this company. Then, if you take the other subsidiary company, which is SWMD, that is the manufacturing and distribution. What is the percentage owning? Very good, 100% ownership. That owns two companies. What are two companies? FMD and FMC. One is dairy products, other one is the? Exactly. Now, I don't think they have mentioned the percentage of ownership, right? Have they mentioned the percentage of ownership of these two companies? They have not, but it predominantly I think it's 100%, but we are not told clearly that 100%, okay? So maybe at this moment we think it's a subsidiary company, but we are not too sure exactly 100% or less than 100%, okay? So just keep it for time being, because that's your unseen material only can tell you. Third company is SWHR. SWHR, what is the percentage ownership you have? Is it clearly mentioned? SWHR, which is basically incorporated to buy loss-making hotels and restaurants, have they mentioned what is the percentage ownership? Yeah. So we don't know the exact percentage, but maybe 100%, maybe 100%, but definitely it's a subsidiary company. It's a subsidiary company. Maybe 100%, we are not sure. So you might think that 100% could be. So under the SWHR, is there any company? Exactly, Coral Beach. So that's a company you own under SWHR. Now the question is, what about the hydro? Hydropower is where? Exactly. It is coming under the SWHR. The hydropower company comes under SWHR. Is it a separate company? SWHR, does it own the hydropower company or the hydropower business is under the SWHR? Exactly. I think there is one place, one engineer mentions that he is recommending to do what? You are right. Very good understanding. They are mentioned in the case SWHR or not SWHR. They are talking about the hydropower project needs to be converted as a private limited or a limited liability company. So that means at the moment it's not a limited liability company, it's a part of your business. Okay. So please make a note of it, because this is at the moment it's not a one entity on its own. It's not an entity on its own, but it's a part of SWHR. More importantly, you started the hydropower because you want to start the hydropower, or you initially started with some other business. What is that? Huh? Yeah, to support the hotel. So what was their target? If you read the case properly, the land was bought in where? Land was bought in Aputale. So you bought a larger land to construct what mainly? Yeah, hotel. Did you build a hotel? You didn't build a hotel, right? We are not told about any story about the hotel building. But you started what business there? Hydropower. Very good. So please note, at the moment the hydropower business is under SWHR, and it is not a separate company, it is part of SWHR. Okay, just keep that in mind. And recently we bought the competitor company, Express Smart. What is that? Is it a subsidiary company? Have they mentioned the Express Smart was bought under what? SW, which company it's bought over? The 711 million, you have bought it. So the 711 million you have bought it under which company? It is coming under the parent company, right? Very good observation. It is coming under the parent company. So you have bought the Express Mart, right? Actually, we don't know whether you are bought as a company or we are taking over the outlets and the properties. How they mention? But they are saying the 711 million you paid, page number 8 of the pre-scene, you bought the company. Very important. So basically the parent company took over what? Yes. So parent company took over the properties and outlets under the ownership of the parent company. So I believe that they have not bought the Express Mart as a company. Right, make a note. For time being you make a note. The Express Mart, you didn't buy the Express Mart as a company. You took over their properties and outlets for 711 million, so that it is becoming your business. It's becoming your business, but you paid 711 million. Okay. So you can think like that, or you can think that you have bought it as a company 711 million. So anyway you have, at the moment you make a note, we will come to that detail later on. For time being just think that this is something I have observed. We will come to further discussion under that. So this is basically the group structure and the business they are in. Now we look at the financial of this group. When you look at the overall financial, page number 9, can we take the page number 9? Everyone, please take the page number 9, your financials. P&L, income statement. You have company and the group. What does the company do? So you mean to say the 300 outlets are under the company?
Yes.
Anyone? Supermarket, can you read your first page properly? First page properly.
Is retail business.
Yeah, retail is a supermarket chain. So actually Stephen started his first company Safeway Holding in 1985, and he opened his first shop in Cinnamon Garden under the SWH in order to cater to high-end customers. His business philosophy was to maximize customer satisfaction. However, Stephen soon observed new requirement of customers and opened his first supermarket by investing 5 million in 1992 under a separate company called Safeway Fresh Mart. So your supermarket is under which company? Yeah, is it under Safeway Holdings? What is your parent company name? Ultimate parent company name is what? Exactly. So what my question is, what is your parent company business? They have, I think there is one place, I think it's mentioned, Safeway Holdings, what they are doing? Anyone who read the case properly? Supermarket, for first information, supermarket 300 outlets are in what business? What company? What? Exactly. So please note the supermarket business, that is your primary or core business, which is having 300 outlets island wide, which is actually the supermarket chain under a Safeway Mart. Okay? But Safeway Holding, that's a parent company. What do they do? They sell the luxury products to a specific customer base, and what is the shop? The Cinnamon Garden, they opened the first shop. Still they continue to run the business. Still run. I think second page, I think it's second page isn't, it's actual first page. The second paragraph, last 2 lines. Can you read it? Second paragraph of the case, second paragraph, first page of your case, last 2 lines. Can you read it please? SWH PLC continues. Can you, what they are saying? Under its direct management and also earns income from what? Its properties which are rented out to? Can you please underline that sentence? So your business, your PLC, that holding company, business is what? Because before you looking at P&L, you should know what they do. So what they are doing? They have one outlet in Cinnamon Garden that is selling the consumer products, right, to high-end customers, and they rent out properties to the group companies and get what income? Yeah. So now tell me, the supermarket business is in which company? Sorry, I didn't get you. Exactly. So is it the parent company or it's a subsidiary company? It's a subsidiary company. So your company column P&L. Now can you look at the company P&L? Can you please look at the company P&L? How much your revenue? Revenue is? Yeah, 95 million is a large amount or small amount? Small amount. So now can you understand, the parent company is running only one outlet and they have other income. How much other income is?
1.8.
So the other income mostly would have come from where? Yeah, other income would have come from what? Rent income, right? So other income would have come from rent income, and probably it would have come from the parent company owns the subsidiary companies. Parent company, does it own the subsidiary companies? Anyone? Parent company owning the subsidiary company. So if it is the subsidiary companies are under parent, what do we get as income? Yeah, intercompany, yeah, we'll come to that. That is accounting. Financial management point of view, I am asking, what is your business of the parent company? One is the one Cinnamon outlet you have, that's your normal revenue and cost of sales, right? That is there in your P&L. Sorry?
Management fee they are receiving from the subsidiary.
Management fee. Have they given anywhere the share of profit management fee story? Or you are assuming? You are assuming. No, don't worry. I am just only allowing you to think this other income. Revenue is small amount. So that practically when you look at it, maybe the one outlet sales, right? But other income, 1.8 billion, could be, you can write it down somewhere, the rent income, dividend income, and somebody mentioned management fee. These are the possible income. But already case has clearly mentioned the parent company rent out properties. So definitely rent out income is there or not? It's there, right? So we know, so that main income is known, then admin expenses, all that, and finance cost, then your profit is 677 million compared to 661 million. So company performance, is it so severely disturbed? It has improved very much or the same like last year? Yeah, so the company point of view, your performance, we don't have to complain much about it, or we don't have to boast about much, because it's similar to the last year performance. And it is small, comparatively small business model, because it's only one outlet and you rent out properties. Now can you look at your balance sheet of the parent company? Page number 10. Page number 10. Balance sheet of the parent company. Can everyone take the balance sheet of the parent company? Observe what you can note on that. You can see there investment in subsidiary companies. Investment in subsidiary company in the parent. How much the last year value? How much the current year value? Investment in subsidiary companies compared to last year, how much the growth? 800 million? I think everyone know you are the chartered accountant, right? Out of 22 million population in the country, only 7,000 members. So you are joining that crowd. Yeah, 711 million. 711 million is what transaction we were talking about? Now you tell me what you noted earlier, the 711 million you paid to buy only the outlets or you bought a company. Can you make a note now? Investment in subsidiaries exactly gone up by 711 million, which is the exact amount we paid to acquire the outlets and the properties of the Express Mart. So in other words, we have bought outlets and properties or we bought the company. Yeah, so now we know that Express Mart is also our subsidiary company, probably 100%. We are buying it, so we assume that is 100%. We have bought it, Express Mart, it is our subsidiary company. Okay, so that is the value difference between last year and current year. Other than that, the company properties, you can see 5.8 billion has become 7.1 billion. So what could have been the investment? What could have been the investment of the company? Sorry, Aputale. Is it under the Aputale land was purchased under the parent company or something else? So how come you now answer saying that property has gone up because of Aputale? All your subsidiaries, investment and assets, all that is under what? Company column or group column? This is accounting I am talking. It's all in group column. So if the company bought anything or invested something, it will be reflected in the company. Now subsidiary company, Express Mart, you bought it under the company, that's why it has gone up. Other than that, the property plant equipment has gone up. So we actually do not know exactly why the property plant equipment went up by 1.2 billion or more than that.
Revaluation?
Yeah, probably the revaluation. Do we have the revaluation? Sorry? We have, yeah. So we have a reserves increasing from 225 to 1142. So that could be probably the revaluation. Maybe make a note of it. Probably, we don't know exactly. Your revaluation would have happened for the property plant equipment. So that is something, a reason for your increase in the PPE and the reserves.
But they have mentioned the revolution of land and building in the profit and P&L.
Where P&L?
The company P&L 952 million increase.
Yeah, OCI. So definitely the reserves increase is mainly because of the revaluation. So if that is the case, the property plant equipment in the company column has gone up by almost 952 million. Apart from that, there is a slight increase in the PPE. That could be your normal investments in some of the assets in the company. So that we don't have to worry too much. But the significant increase in the PPE is mainly because of what? Yeah, so make a note of it. Other than that, if you take your company balance sheet, you have investment property. That has gone up. Why it has gone up? The investment property has gone up because of what? The company has investment property. Why the company investment property has gone up?
New outlet. Okay, for a new outlet.
I think somebody is working on a Nugegoda, right? So it's more than that. You are talking about, if you have investment property, what do you do? From accounting point of view, what do you do? Exactly. You need to do fair valuation on a yearly basis, right? So if you are going to do the fair valuation, that fair valuation gain also will be added to the investment property. Okay, more than you buying, because you are talking about only 60 plus 70, 230 million you have bought it, if at all. We are not sure whether you bought the investment property or it's a fair value gain. If it is fair value gain, where do you account for the fair value gain? P&L. Do you have any fair value change? Fair value loss of? Yeah. So you are talking about net increase of 231, but fair value loss of 19 million. So definitely you have bought a property for how much?
250.
Very good. 250. So can you make a note somewhere? The investment property you have bought for 250 million. We don't know exactly what it had been bought, but it reflects the investment you have made. Make a note of that. Okay, so that is basically your assets on the top side. Then under the current assets, you have a related party receivable of how much? Current assets, how much we have? Related party receivables of? $1.5 billion. So you have a receivable of 1.5 billion. Maybe because of your properties are rented out to your group companies, you may have a receivable from the outside your group companies, or maybe with the other parties you have a receivable. So let it be. We will come to that little while. So in terms of balance sheet, other than those items we mentioned, then you have your non-current liability, 618 million loan, that is interest bearing loans. That is important. We have to know that they have borrowed money. Apart from that, the interest bearing borrowing for current liability also there is 1.2 billion. So you have debt, interest bearing borrowing, short term and long term, even in the company. So those are not a significant things, but just have an idea. Now we know what is company. Now we look at a group. That is important area. Can you look at a group? Group P&L, page number 9. Group, page number 9, your P&L. Now can you now calculate, I think now it's a time for calculation. Revenue, overall revenue, group, how much it has dropped? Your revenue has dropped by how much? Group revenue. Ana 8 billion become ana 6.5 billion. So revenue overall has dropped. What is it dropped?
1.5 billion.
Not the amount, percentage. 1.4% drop in your total revenue. Profit? Profit dropped? So 80%. 18%. We are talking about group profits. Profit means profit after tax. 0 point. Yeah, 54% drop. Now can you read the finance director statement, page number 7. Page number 7, the second paragraph. Group, strategic position, current and future. Can you read that paragraph? What the finance director says? The poor performance of the group, according to finance director, he said that the group has been performing badly, refer annexure 1 and 2, and he summarized the results of the performance and alarming due to the sensitive business operating within the group. So he said the revenue has gone down by 1.4%, whereas group gross, sorry? Can't hear. According to finance director, can you hear me now? According to finance director, your revenue has dropped by 2% and your GP has dropped by 18% and your profit after tax dropped by I believe everyone knows where I am talking. It's about page number 7, second paragraph. Page number 7, second paragraph. So we also now looked at the group P&L. Revenue dropped by 1.4%. Group profit dropped by 54%. This is the concern he was having. Your slight drop in your revenue has disturbed your profitability significantly. Then he mentioned about the segmentation. Segmentation. Now, I believe that all of you all have the segment P&L. Can you go to the segment P&L? Page number 12. Page number 12, segment P&L. Can you look at your segment P&L? You need to get your segment, the contribution in terms of revenue and in terms of profits. That table has to be calculated. Now I can't write in the board, maybe you are not able to see it, right? So what I want to tell you is the revenue and the profit, 2 columns, revenue and profit 2 columns. You need to find out how many segments we are talking about here. How many segments? Yeah, what are segments we are talking? Exactly. Now it is not, the segment doesn't mean it is the company. Each segment is one company. It may be one company or maybe the too many companies together fall into a one segment. So it doesn't really mean that one segment in one company. Don't get that picture always. The segment is that nature of business. Each business nature you decide that is a separate segment. So in that case, retail, manufacturing, distribution, restaurant and hotels, and power and other. There are 5 segments we are talking about. In terms of revenue, can you find out which segment contribute what percentage? Retail segment, what is the segment contribution in terms of revenue? You can look at your group P&L, total revenue is given under 6.5, and your retail segment, what is the revenue we are generating? After inter-segment you are reducing. How much? 79%. Very good. Exactly. So can you write down that? You know that retail segment contributes 79%. Retail segment contributes 79% in terms of revenue. And manufacturing and distribution? 16.9%. How much? 16.9%. Yeah, please round off, I don't interested about the decimals, we will get the total percentage. 17% in terms of manufacturing and distribution. Restaurant and spa? %, exactly. And the power and the other operation is not a significant contribution. Power and the other operation is not significant contribution in terms of revenue. So out of the total 5 segments, which segment is the key segment? Yeah, that is what? Retail mean what? Supermarket. I am not interested about name. What business is that? Retail is about supermarket. So your revenue almost 80%, that is 79 mean 80%, revenue comes from what? Supermarket business. Now come to the profits. Can you look at the profits? How much of overall group profit is? $1.8 billion. Out of 1.8 billion, retail segment contributes what profitability? What percentage? 83 or 81? I think it's 81. Please look at your profit properly. 1.863 profit, and your retail segment contributes how much? Yeah, so which is how much? $83. Okay, I also calculated 81. Okay, so 83. Okay, 83, and manufacturing distribution comes to manufacturing and distribution comes to what? Exactly 19%. And restaurant is restaurant, is it a significant contribution? Yeah, not a significant. Power generation? Power generation is a profit or loss? Power generation is a loss generated. So we will know that. And other operation? Other operation? 30? Very good. So we have got an idea now. If you take this group, revenue point of view, who is mainly contributing? Retail. Profit point of view, who is mainly contributing? So revenue and profit both point of view, supermarket contribute what percentage? 80%. Exactly, 80%. Second contributor is? Exactly, manufacturing. So in terms of other operation, what are items in other? Sorry? What business? Now you read, retail business is a supermarket, manufacturing and distribution includes what are the businesses? Chocolate manufacturing and dairy products. What else? I didn't get. Yeah. So you look at your parent company P&L. Your parent company's business, what business we are talking about? Yeah, parent company has one outlet in Cinnamon Garden. It's a consumer foods. So which falls into what business? Exactly, it's a retail business. So it's already considered under retail. And the parent company has another thing which is about renting out properties. So that may be falling under what? Yeah, exactly. So please make a note. We are not too sure what exactly the other represent, but probably the other could be including the rent income from the properties of the parent company. Because other businesses you have put it into different basket. Okay. Restaurant and spa mainly includes what?
Coral Beach and hotels.
Yeah, Coral Beach, one hotel and
Franchising restaurant.
yeah, franchising the luxury restaurant. So those are the possible thing under resorts and restaurants and hotels. Power generation, of course, we are told clearly there is hydropower generation. Hydropower generation, but it's a loss making. It's a loss making. So other operation is profitable. So they have got some idea now who are contributing what percentage in terms of revenue and the profits. Now we move on to the each segment very clearly, because to answer some of the issues we will be asking, we need to know the each segment certain ratios. So maybe if you have not done calculation of ratios in the earlier, you may write it down. retail segment. You take segment by segment, retail segment, 2022-21, 2022-21, retail segment. You have two columns, right, 22 and 21, retail segment. Revenue dropped by what percentage? Yeah, so revenue drop in retail segment 1.8%. So it's just a top line story, The retail segment had dropped 1.8%. So just make a note. Then the GP margin. Can I have the GP margin for 22 and 21? How much is retail segment GP margin? You everyone please do it, because otherwise there is no analysis. GP margin 22 how much? 21 how much? So how much is GP margin?
11 and 13.
Exactly. GP margin 22, 21. For the retail segment, GP margin 11 and 13. That means GP margin has increased or reduced? Compared to 2021, retail segment, which is our primary business or core business, which GP margin has dropped or increased? From 13 to 11. Second one, calculate operating return on assets or return on total assets. Return on assets. Can you please calculate? Return on asset, next ratio for the profitability purpose. Return on assets. How do you calculate? Return on assets, how do you calculate? Return on assets you calculate, divide the operating profit by the total assets. Operating profit divided by total assets. So in the segment P&L they have said segment operating gross profit. How much is the segment operating profit? Retail? Sorry? 4.2 billion. 4.2 billion. So that divide by the segment total assets. Do we have the segment total assets? 9 and
13%.
Yeah, it is 9 and 17. 9 and 17. 9 and 17. So profitability of the retail segment, what had happened? What is the observation? GP margin increased or reduced? GP margin reduced or increased?
Reduced by 30%.
GP margin reduced by 17%? No. GP margin last year how much? Current year how much?
13% and 11%.
Yeah, 13 and 11. Operating return or return on assets last year how much? Current year?
17%. 9%.
Exactly. So 17 and 9. So we know that overall retail segment revenue dropped by almost 2%. GP margin has come down. Operating return on assets has come down. Why? Why the retail segment revenue drop? That you can attribute to the inflation is going up in the market, or disposable income would have come down to the customers and the prices have gone up in the market, but people can't buy. It's not about price increase, but people can't buy. So then definitely your revenue can drop. So that is one reason revenue drop you can be attributing. But why the operating profit is dropping or GP margin is dropping? which means what has happened? Exactly. So can you write down under the retail segment, can you write down this ratio you calculate, then you are saying the reason. One is the drop in revenue, that is the one reason for your profitability coming down, drop in revenue. Second one, increase in cost of sales, within bracket high inflation, increase in cost of sales within bracket higher inflation. Third, increase in overheads, because operating profit when you calculate, overheads are reduced. So increase in overheads, because you should know the transport cost in our country, increase or reduced. What was our petrol prices last year November? Yeah, 170 or 160 or whatever, 1 litre petrol. What is the petrol price today? Exactly. So it is almost double. So will that affect the business of supermarket chain?
Yes.
How?
Transporting the goods from the store to
Very nice. So write down, that's an important cost increase, right? It's important. Maybe the salaries wouldn't have gone up so much, but your transport cost double, triple sometimes, right? Because you have how many outlets we talked about? 300 outlets. So to buy the goods, to buy the farming goods, to manufactured goods to distributed to the outlets, do we need transport?
Yes.
Very much. So those transport costs will affect our business significantly. So can you write down that? Significant increase in the transport cost. Even though all the overheads went up, significant increase in transport cost, especially for a business like ours, 300 outlets, you have to collect the goods from the farmers. Now actually you would have seen TV, media, you would have seen that the farmers may be saying that sometimes the vegetables and the other items they manufacture or harvest, they are not able to sell it to the customers because no one is coming to pick the goods. Because the transport cost is very high, so it may not be worthwhile. Sometimes the people don't collect it. If you say your farming land is in the interior village, right? The transport cost to pick the same kilograms of whatever fruits or vegetables is more expensive than the cost of the product. So it's very unfair, but it is a reality. So you need to understand that affect your supermarket chain. And did electricity cost go up?
Yes.
Did electricity cost go up? Is it having impact on our business? Supermarket chain. What time? Sorry? This is after March. Okay. So you may make a note of it, electricity price going up next year, because you will have a valuation question anyway for the forecast. So please note that the cost is going to go up again. But if you take a March financial, you may not have that impact. Any other cost increase? Exactly. You are manufacturing chocolate, you are manufacturing dairy. Do we have impact of any cost escalation? Yeah, so can you write down import restriction of some of the products? Import restriction. Because of import restriction, the cost of the products have gone up. Import restriction have resulted in the price increase of the goods. Then the exchange rate depreciation. Severe exchange rate depreciation. Which impacts your packing material, your import goods. Import goods. Because this is your key business, core business, 80% contributor. So you should know why in and out, why that profitability affected. So your cost escalation coming from the import goods and your import restriction resulted in lack of supply. Some of the chocolates, some of the products are not available. Packing material, you may know that we didn't have sometimes the paper. We didn't have the paper. We didn't have the relevant packing material. So these all have a problem, right? Even the toners, cartridges, printing related stuff. So if you don't have it, how do you pack? How do you price it? So these all have impact on your business because you are a segment of retail and you are manufacturing certain products. Even the dairy products, you have the impact. Okay, so all these have escalated our cost of sales and the overheads. Cost of sales and overheads. Transport costs, everything we are talking about. Container cost, right? If you are importing goods, you use containers. Sometimes even the distribution may take in the container. You would have seen those days the container charges went up by 60%, 80% like that. So those impact your products or they impact your profitability. So that's your retail operation impact, The second one, manufacturing distribution. Can you write down? Second one, manufacturing and distribution. What is the revenue drop? Manufacturing distribution, what is the drop? Is there a drop?
0.4%.
Yeah, basically is it negligible?
Yes.
Yeah, so revenue drop is not a significant, there is no growth, but there is a drop, but it is negligible. So don't worry about it. GP margin, manufacturing distribution, GP margin, what happened? Same calculation, 22, 21, GP margin. Manufacturing and distribution primarily on two businesses, dairy and chocolate. GP margin. So how much is GP margin? Sorry?
11% and 13%.
I don't think. I am talking about manufacturing and distribution.
9 and 7%.
Yeah. 7 and 9. 2022 how much?
7.6.
Yeah. Round out. Don't worry about decimals. Not bothered. 7 and 9. 7 and 9. And operating return on assets? That is return on assets. Operating return on assets? That is operating profit divided by total assets of that segment. How much? Very good. 5% and 9%. So GP margin dropped from 9 to 7. Operating return on assets or return on assets dropped from 9 to 5%. Now tell me why it happened. Why the manufacturing and distribution? What does they do? Manufacturing and distribution, the chocolate and the dairy, what do they do? Yeah, they may import raw material and they manufacture chocolates and the confectionery items and they sell some of their products manufactured, they sell it to where? Exactly, that's why you have an inter-segment revenue transfer. So you sell some of the revenue, you basically sell the products to your retail segment or another company within the group. So that can be eliminated, that is already eliminated. But you sell on your own also to outside parties, your own outlets, or you may sell it to the distributor directly. So why that margins have come down? Again, some of the reason what we mentioned earlier. transportation cost, your raw material import cost, your packing material cost increase, all that are the reasons why your cost has gone up. Cost has gone up. So this is manufacturing and distribution. Third one, restaurants and hotel. Can you take the restaurant and hotel? Third one. What is your revenue drop? Restaurants and hotel, what is your revenue drop? Yeah, revenue drop is 4%. Can we have the GB margin and operating return? GB margin. Yeah, GB margin current year 11%, last year 13%. That is also dropped. Operating return. How much?
7% and 12.
Very good. 7 and 12. 7 and 12. That means 2022 is 7. 2022 is 7. Last year 11. Or last year 12. Now restaurants and hotels. Why the margin has come down?
Increase of food items.
Yeah. So the inflationary impact. You can see the inflationary impact. What else? It's hotel. Now please note, I think at this point I better tell this, hotel industry or the supermarket industry. This industry, your fixed overhead is very high or variable overhead is high? Supermarket chain and the hotel business, which overheads is higher? Fixed or variable? So if you take your out of total expenses, fixed nature of expenses are very high, what risk is that? Yeah, you will have a higher operating leverage. Can you write down in a bold letter in your answer or maybe your analysis, the hotel industry and the retail segment, hotel industry and retail segment is exposed to very high fixed overheads, very high fixed overheads, very high fixed overheads, and therefore the operating leverage is what? Operating leverage is high, operating leverage higher, right? So please note that you can calculate your operating leverage number also. But understand the principle that since you are exposure to the overheads, fixed overheads are very high, you have a higher operating leverage. If you say higher operating leverage, what risk is higher in your business? Business risk. Now you may understand, if you say hotel, if you have a hotel, if you have a building and the resources, all the thing, you will incur your depreciation, you incur your fixed salary staff, and you have to incur your electricity cost. All the costs are fixed. Whether you have 1 customer or 1000 customers, same overheads you have to incur. So that is a very high exposure to fixed overheads. Retail segment, supermarket, take Cargill's Keys, any supermarket. Whether you have anybody walking into your outlet today, what is the cost you have fixed?
Building rent.
Yeah, building rent, then electricity, whether you like it or not, from 8 o'clock in the morning till 11 o'clock in the night, you have to put your lights and AC, right? Light and the AC you have to always on, so your electricity cost is high. Whether you get 10 customers or 1000 customers, you will have the same electricity cost you have to incur in the outlet. What else you incur? Salaries of the staff. Your outlet may have 10-20 people. That 20 people, whether there is a sale in that outlet or not, you have to pay what? Your salary, transport cost, food allowance, all have to be paid. So what you need to understand by now, your retail segment, which is a predominantly your business model, that have a higher fixed overheads, otherwise you have a very high operating leverage. Therefore, what is the way out? We will come to that detail, but what is the way out for these kind of industries? Your higher exposure to fixed overheads, what is the way out? I can give you some more example. Say the malls, One Golf Face, City Center, Marina Mall, all these malls, whether you have 1 customer, 1000 customer, your costs are fixed. What are costs you have in the malls? Main cost, rent, maintenance, staff salaries, electricity, all that are fixed. Whether you have sales or no sales, cost is fixed. So that means your business risk is very high or lower? Very high. So please be aware of this, because COVID point of view, COVID period, all these businesses realize this exposure and then they felt they all make losses. Why? Because they are exposed to higher fixed overheads. Whether you have sales or no sales, you have to incur that cost. So here the good example, in our 2 segments, retail segment and the hotel segment, we have to incur the high fixed overheads. Okay, keep that in mind for time being. Power segment. Now move on to power segment. Power segment profitable or loss making? Why the power segment is loss making? In 2019 we started supplying power, 2019, and we actually put the hydropower 1.5 megawatt investment for what purpose? Sorry? Yeah, excess power to distribute to government. Before the excess power, we are actually putting up the hydropower for what purpose? We put it for the hotel purposes. Did we build the hotel? So what are you doing with the power generation then? We are selling to CEB. You are right. You are selling to CEB. Hydropower projects, please understand, there is no question about first year of operation, second year of operation, 5 years later they will make profit. That kind of business you can tell for the hotel industry, hospital industry, you can say that. Why? Till the customers get used to that name and the brand and the doctors and the hotel services, it will take time to establish the customers. But hydropower, there is no question about it. The hydropower, you are generating power from what? Hydropower you are generating from fuel? Hydropower is from the water. So page number 5 of your pre-scene, can you read the first paragraph? Yeah, renewable energy, that is from the water. Hydro means water. Wind is from air. Solar is from the sunlight. And thermal power is the oil based. As a Sri Lanka country, we are predominantly developing or producing power from the what power? In Sri Lanka, what is our main power generation contributor? Thermal and coal, which is the renewable energy? What is renewable energy? Solar, wind, hydro are the renewable energy. Solar, wind and the hydro. And are we mainly contributing the power generation from that or from the thermal, oil and the coal? Exactly. So please be aware as a Sri Lankan citizen that we are generating power mainly from the oil and the coal. So for which is it costly or less cost?
Costly.
Yeah, and that is mainly you are doing what? It's a natural resources or you are importing? So you have problem with the dollars. So when you say your dollar exchange has depreciated 100%, your cost of power generation is higher or lower? Double. That's why the electricity tariff was revised after March, and then they are now talking again to revise it. So that's all for your general knowledge, nothing to do with this paper. Now we come into this paper. This company is producing hydropower 1.5 megawatt. Mainly they wanted to put up this hydropower to produce for their hotel business. But did they invest in the hotel?
No.
Yeah. So they bought the land in Aputale and they had a small waterfall. From that they produced it. Now you need to understand the hydropower generation will depend purely from what? Water flow. So when do you get more water flow?
Rainy.
Yeah. So if you don't have a good rainy period during the year, not for Colombo, I am not talking about Colombo, the area where your hydropower is generated, there you should have raining. So if you continue to have the raining there, then what is the benefit? You have more power generation, that means more sales. So in this company, we don't know exactly how much the rainy season was there during that period, but the revenue is only 96 million. And your expenses is how much? Segment, page number 12. Expense is how much? Sorry? 492 million. So why the 492 million? So possible reason for your loss making hydropower. What are reason?
Depreciation of the plant.
Yeah. So again you might say that higher depreciation. Can you write down? Possible reason for loss making power segment. 1. Higher depreciation. Higher finance cost. You have 281 million finance cost, which means you have borrowed money and invested. You have finance cost, and you have a higher overheads, mainly the depreciation, and lack of sufficient rainfall. Because hydropower generation purely dependent on the rainfalls. If you don't have sufficient rainfall, you will be loss making. It is directly relevant to the nature, nothing to do with dollar rate. Is directly linked to the nature. So if you don't have rainfall, you have a problem. Similarly, solar project, if they talk about, solar project depends on what? Sunlight. So please note that these are the relevant factors to be considered. So we are not told much about it. What possible reason is the rainfall could have been very much lower, so no revenue or sufficient revenue. Second, your higher overheads includes mainly the depreciation component, because you have put up the plant, that plant 250 million has to be depreciated, so there is the depreciation cost comes in, and your overheads, whatever the overheads you have incurred. Maybe you might have done some work on the hotel. We don't know. That information is not given. You might have done some work for the hotel. That cost is also in the power. Can you make a note there? Your overheads could be including depreciation, engineers, all that cost. But apart from that, you may have some cost of the hotel related. Even though you didn't construct the hotel, maybe you would have recruited people, you have done some work for the hotel, that cost could be there here. We don't know, right? Just a question mark there. Finance cost, because you have taken loan to buy the thing, you would have incurred the finance cost. So you have got now idea about each segment profitability, how the company has profitable has been. Can you now read it? Page number 7, last paragraph, finance director statement in terms of the group profitability. Can you read it please? We started early also. Page number 7. Can you please read the page number 7, last paragraph? It continues to page number 8, first paragraph. Page number 7, last paragraph to page number 8, beginning. So what is the finance director is saying? What he wanted to do? What the finance director wanted to do?
Immediate attention to investigate and to implement appropriate strategies to overcome this kind of disaster.
Very good. I think this will be a one question in your paper. Your unseen paper, possible question is that. Investigate or identify the possible causes of the lack of performance or poor performance and appropriate strategies. Now, did we analyze the case on the P&L? We have got idea about the segments? Yeah, now tell me, if I put it overall, what are the possible reasons? What are possible reasons for the overall profitability less profitability? What are possible reasons for the less profitability? We got enough reasons.
Fixed cost in this side.
Sorry?
Side.
High fixed cost in the
Yeah.
High fixed cost.
I think first you start with revenue drop. First thing is revenue drop. All the 3 segments, the main segments we are talking, revenue drop, not 3 segments, 4 segments, including power. Including power segment, all 4 segments, you can see that revenue is lower. Maybe the power segment, your revenue compared to last year, no change much. But in terms of your business model, do you have sufficient revenue or you don't have sufficient revenue, power generation? Yeah. So the revenue drop or insufficient revenue is main reason for your less profitability. One. Second, higher fixed overheads. Higher fixed overheads. Now you have to support whatever we did it earlier. I am not repeating the same thing, right? So retail, manufacturing, you can talk about all the segments. Now I am just overall putting it together. Higher fixed overheads. What else? Yeah, high cost of sale, don't say the high cost of sale. That means you are just looking at P&L writing. Higher inflation in the country. You are aware of it. You are aware of it. High inflation in the country. Right? That arises from what? Import restriction. Write down that. Import restrictions, one reason. And lack of harvest. Sufficient harvest, the fertilizer problem. Most of the harvest of the products, agriculture products came down because of the lack of fertilizer. Right? Lack of harvest. What else? Rupee depreciation or devaluation. Significant rupee depreciation and devaluation. So these are the main reasons why you have higher inflation. Whatever we have discussed, you can add on. I am just giving you a summary form. I am answering a question which is probably can be there in your unseen question. Possible reason for the lack of performance, as finance director mentioned. Higher inflation, higher fixed overheads, what else? What could be the other reason? Yes, very good. Higher finance cost. Higher finance cost.
Transportation cost.
Yeah, that you can talk about under inflation. Transportation cost, packing material cost. You can elaborate these things because these we already discussed. you can elaborate. I am not writing everything, I am not explaining, so you can write down all that. Transportation increase significant. These are not the 10%, 5% increase we are talking. We are talking about 80%, 100% increase on most of the goods. So that has impacted. Transportation, packing material costs have gone up because no packing material available. Sometimes you would have seen that the printed cards were not available, right? You would have seen that even the revenue, licenses were not issued in the country, right? Even the passports were delayed. So there are a lot of things because these all are import items. And when you say import restriction, many of the items didn't come. So when the many of the items didn't come, you are getting into a high cost environment because the supply is only short and demand is there, so your cost goes up double, triple the price. Okay? So these are the reasons, possible reason. You detail as we discuss on each segment, you can write it down. So that's about your profitability story. Now go into the next one, liquidity. Can we go to liquidity? Can we take the balance sheet? Now P&L done. P&L done. Can we look at the balance sheet, please? Reasonably we understood the P&L and the impact and the reasons we have analyzed. Now look at the balance sheet. Company balance sheet, we have discussed about it. We know what it is, no problem. Balance sheet of the group, can we look at the liquidity? What are ratio we calculate for liquidity? Sorry? Current ratio and the quick ratio. Can you quickly calculate? Current ratio and quick ratio for the group, not for company, because company is only just a small business. Group only has all the businesses. So what is your current ratio? Can I have the current ratio, please? 2022, 2021. Quick ratio. .8, very good. 2022, 0.8 is to 1. 21, 0.73 is to 1. 0.8 is to 1, 0.73 to 1. Quick ratio? I didn't get you. 0.4 is to 1 and 0.34 is to 1. So, what is your situation of the current ratio and quick ratio of the group? First of all, you should know what is current ratio, what is quick ratio. Current ratio basically sees whether to pay 1 rupee of liability, how much liquid assets you have. To pay 1 rupee of liability day to day basis, how much your liquid assets is. So this company to pay 1 rupee as a group, how much we have?
0.8.
That means 80 cents. To pay 1 rupee, how much money we have? 80 cents. So if anybody, a supplier or the employee or any other creditor comes and asks for a payment of 1 million, how much we can pay him?
800,000.
Very good. So you understood. Quick ratio. What is quick ratio? You really look at the liquid ones, very liquid ones. So you remove the inventory. If you remove the inventory, what is the quick ratio basically indicates? 0.4 is to 1. To pay 1 rupee, how much liquid assets we have?
40 cents.
40 cents. So 1 million rupee payment, how much we can pay?
400,000.
So are we having problem?
Yes.
What is this problem called?
Liquidity.
Yeah, liquidity problem or cash flow problem we have. So liquidity problem and the cash flow problem, if the company is having, can you manage your business?
Difficult.
Is it difficult or can you run or you will close down quickly? If you can't meet your supplier payments, if you can't meet your bank's payment, if you can't pay your salaries of the employees, if you can't pay your utility bills, can you run your business? You don't pay the electricity bill, your supermarkets will not have lights. Is it okay? You have 5,600 employees, you don't pay their salaries or food allowance. Will they work in the company? So is it possible for you to run the business without paying your suppliers, employees, all the creditors on time? So your liquidity ratio indicates you are into severe cash flow problems. Did anywhere it is mentioned? Did it mention anywhere?
Yes, there is a cash crunch.
Yeah, page number 8, second paragraph, they say that the finance director mentioned that group is heading towards what? Not just a cash flow problem, severe cash flow issues. Severe cash flow problem. Can you read that paragraph? Page number 8. Page number 8, second paragraph. What do they say? According to finance director, what he is saying?
Because of severe cash flow issues, they need to go for a working capital management for the group.
No, they are working on management. Can you read that paragraph and tell me what exactly they are saying? You have a severe cash flow problem. Severe cash flow problem. So you need to take what? You need to take immediate policy decision with regard to working capital management of the group. So this is another part in your question in the unseen material. They can ask you whether the company or the group is having working capital problems. Question is what? Working capital problem is there or not? Severe problem is there. So what do I do? Or what do we do to reduce that problems? Sorry? Yeah, now you need to see the overall picture, right? I will come to that answer little while. So we understood there is a working capital problem, severe problem, which has been evidenced by our ratio, liquidity ratio, 0.4:1 and 0.8:1. That shows that group has a severe working capital problem. Severe working capital problem. Keep that in mind. So the company group, if you take group point of view, the profitability is good in this group. Liquidity is good in the group. Okay. Now the third one, can you calculate gearing? Quickly, can we calculate gearing of this group? 22, 21. How do you calculate gearing? Debt capital divided by debt plus equity. Can you please get the debt capital? Current liabilities also have interest bearing loans. Group non-current also have interest bearing borrowings. Can you find out the total interest bearing borrowing? 22 debt capital is how much? No. That actually the lease accounted is for what purpose? If you the lease liability in your balance sheet is because of what? Yeah, outlets. Actually this is what entry you have done. Now because earlier those days we have a lease liability for the motor vehicle you purchase on the lease or the machinery you have bought it on the lease. That is finance lease. Here we are talking about what lease? I believe that you have known accounting, right? Can you look at your balance sheet assets point of view, asset side? Right of use assets. What is the double entry? Right of use asset debit, credit to lease liability. Do you really incur a interest cost there? I believe that you all understand accounting first. Right of use assets and the lease liability what you accounted, is it a borrowing you have done? People who don't understand that accounting standard, please look at the accounting standard. Accordingly, it's a double entry only. It's a double entry only. Do you borrow money from anyone? Yeah, I believe that you have to go through that anyway. So there is no interest involvement. There is no outside loan agreement to pay interest. So therefore, that is not a debt capital. So your debt capital is only what? Interest bearing borrowing, short term and long term. Can I have the total amount? What is your interest bearing borrowing, short and long term? Exactly. So your debt capital 21,487. Equity capital? Equity capital. Yeah, equity you are saying immediately your 28,506 including minority, excluding minority. Yeah, so you ideally should take the excluding minority because the minority is not relevant to your shareholders. It is the subsidiary company shareholder outside. So can we take the our equity only? Yeah, 25,768. You add this total, how much? 47. Yeah, last year 16,501 debt, equity 21,602, total 38,103. Can you now tell me the gearing ratio of the last year and current year? 43 and
45.
yeah, current year is last year 43. Can you please tell me the company is low geared or high geared? Yeah, less than 50% low gear. Less than 50% low gear. Now, you know the gearing point of view, it's not a high geared company. It's not a high geared company. So, the low geared is not a bad idea. 43% is not that high geared, but it's reasonably you have borrowed money. Now, when you say you have borrowed money and invested in business, your business should generate what? Your gearing decision making will work on what basis? Your return should be, your return should be more than what? Return should be more than cost of debt. So please understand your return has to be more than cost of debt for you to borrow money. Return has to be more than cost of debt to borrow money. And the operating return on assets we calculated earlier. Can you go back to the operating return on assets what you calculated earlier? Operating return on assets, your retail segment, how much operating return we are making? Yeah, you are earning an operating return of 9%. So your cost of debt has to be how much? Yeah, so now you need to tell me your cost of debt, can it be below 9%? The pre-scene doesn't say exactly the cost of debt how much, but we should know cost of debt in our Sri Lankan market today. Of course, cost of debt is 30% plus. Say 2022 we are talking, is it less than 9% cost of debt? About 9%. So are you generating sufficient return for debt holders? Are you generating sufficient return for debt holders? Yes or no? No. Can you write down that? Based on the operating return analysis, based on the operating return analysis, based on the operating return analysis, we can say that, based on the operating return analysis, we can say that company or the group is not generating sufficient return for Group is not generating sufficient return for debt holders. So your knowledge, you tell me cost of debt, cost of equity, which is expensive? Cost of equity. So if you know that, and if your business model is not generating sufficient return for debt holders, are you generating sufficient return for equity holders? Not at all. So you are not able to earn return for shareholders. Can you write down next line? The group is not generating what? Exactly. Group is not generating sufficient return for equity holders. Okay. So please note, your business model at the moment is not generating sufficient return for debt holders, then automatically we understand that you are not able to earn return for shareholders. Okay. Even though you are a low geared company, you are not generating sufficient return. It is up to 2022 March. Now you need to now understand when the interest rate started increasing in Sri Lanka. Very good. April 2022 the interest rate started increasing. Before 31st March 2022 performance, are you earning sufficient return even at that time? Are you? No. So now tell me, what is the cost of debt today? Yeah, something like that, right? 25 and above. So are you able to earn return for your shareholder and debt holders? Okay, keep that in mind for time being. So we have got some idea now in terms of gearing, even though low geared, but you are not earning sufficient return for debt holders. So we have got an idea. Now can you calculate the shareholder returns? Shareholder return is what? 2022, 21, calculate return on equity. Return on equity. How do you calculate return on equity? How do you calculate return on equity? Since it's a group company, please understand return on equity. How do you calculate? Profit after tax. Very good. Profit after tax attributable to shareholders of which company? Parent. So how much is relevant profit? 2022, your relevant profit is how much? 1693 divided by equity capital. How much is equity capital relevant? Sorry? 25,025,768. So what is your return on equity? How much return on equity? 6.6% return on equity for 2022. 21? $21? 3 point. What is the last year profit? 3515 divided by 3515 is the attributable profit last year. Last year equity is how much? So what is your return on equity? 16.3. So what had happened? Return on equity increased or reduced? Significant impact, significant drop in return on equity. Significant return drop. So we discussed many reasons why the profits are lower, all that. So that is attributing to the shareholder return also. Now we go and calculate what is the cost of equity. What is the cost of equity? Can we calculate cost of equity? How do you calculate cost of equity? Cost of equity, how do you calculate? CAPM model, CAPM. Cost of equity equals to risk-free rate plus beta risk premium. Risk-free rate is how much? I think they have given somewhere your company market information. Risk-free rate is how much? And beta is 0.51. How much risk premium? So what is your cost of equity? 29.55. Generally the examiner gives you the cost of debt, but I think here the cost of debt is not clearly given. If you are given cost of debt, you know the cost of debt after tax how much you can calculate. Then what you can calculate? Weighted average cost of capital, where you know the gearing is 45%, multiply cost of debt after tax plus cost of equity 29.55 into 55%. That will give you the WACC. Since we are not given the cost of debt exactly, we are not calculating cost of debt and WACC at the pre-seen, but unseen level we can calculate that. Unseen level we can calculate that. But before that, what is your cost of equity? How much your cost of equity? Yeah, almost 30%. Now that is actually the latest position, right? The cost of equity they have given you the information is the 31st March 2022, that point in time, right? So that basically we calculate 30%. But if before that period, if you look at it, it wouldn't have been 30% requirement anyway. But when it comes to March 2022, it is 30%. Now in this company at this moment, what is the return on equity we are talking? Return on equity is how much? Yeah, so what we are understanding? Are you generating sufficient return for shareholders? Cost of equity in other words is required rate of return of the shareholder. Cost of equity in other words is required rate of return or the expected return of the shareholder. If the expected return of the shareholder is now going to be 30%, are you earning sufficient return? So if you don't earn sufficient returns, share price goes up or comes down? Share price? So if the share price comes down, you are creating wealth or you are destroying wealth? Are you creating wealth for the shareholders or destroying wealth for the shareholders? Primary objective of the company is what? Exactly. So are you maximizing or minimizing? Okay. So that is what we understood already by analyzing this case. Now I think there is the information about the P ratio. How much is industry P ratio? 10.61 times industry P ratio. If you are going to calculate market value based on P ratio, how do you calculate market value based on P ratio? In EPS into PE. How much EPS of the company or group? 2.47. P ratio is how much? 10.61. So what is your market value per share? 26.2. Market price of the share is how much? Market price of the share? 32. So, your share price in the market is trading at a higher P ratio than the industry or lower P ratio of the industry. Now, if you take the industry P ratio 10.61, your market price is how much? 26.2. If you say your industry P ratio is applicable to you and if you calculate the market value per share, your price of the share is 26.2. But your share in the market is how much at the moment? Sorry? So that reflects that your market, your share is trading at higher P ratio or lower P ratio? Higher P ratio. So can you make a note there? Your company at the moment comparatively to the industry trading at a higher P ratio. Trading at a higher P ratio. Sorry? Yeah, that is you divide the 32 you divide by 2.47. So what is your company P ratio? 13 times. So which is more than the 10.61. So that you are aware at the moment your share is trading at a higher P ratio. Trading at a higher P ratio. So when I come to the valuation perspective, if the examiner asks you a question about value the company, value this group actually, value the group using different methods of valuation. Firstly, we look at the net asset basis of valuation. How many net assets of the group? If they ask you what is the value of the group, if anyone is want to buy the company or group, what is the value of the group? Net asset basis. How much I have to pay to buy the group? Exactly. 25,768 millions. That is net asset basis. Then we go to the PE method of valuation. PE method of valuation, how do you calculate the total value? EPS into PE ratio is one share value. Total value if you want to calculate, what is the formula? Yeah, so what is the profit after tax of the group? Again, profit after tax, we take the 1863. Exactly, attributable to parent company. 1693 multiplied by what is the industry PE ratio? Industry PE ratio is 10.61. So what is the value of the company? Sorry? 17,963 million. If I go on the market value, that is market capitalization. Can I calculate market capitalization? How much is market capitalization? How do you calculate market capitalization? Yeah, share price is how much? 32. How many shares? We are not given the number of shares, I believe. But from the stated capital 6.8 billion, if you assume the share nominal value is 10 rupee, how many shares? Yeah. So you divide the profit attributable divided by earning per share, how many shares you get? That is 1693 divided by 2.47. 685 million. That means what is the nominal value of the share? Yeah. So 685 million shares into 32 rupees. What is the market capitalization? How much? 21,920 million. Now see, these are the valuation of the company using different methods of valuation at the pre-seen level what we can calculate. Maybe at the unseen level the examiner will give you free cash flow method of valuation and he will give you the cash flows and ask you to calculate the value apart from the values that we have calculated. Even for net assets he can give you some more adjustments for the group balance sheet and say inventory has to be obsolete, you have to make a provision, debtors needs to be provided for. Maybe the revaluation, again you do the revaluation of the assets, all that adjustment you do it and calculate new net assets or adjusted net assets. PE method of valuation, he might say 10.61 is not the industry PE, you may use the market PE which is maybe 12 times. Then you calculate a new market value. Market capitalization of course won't change, so you can take it. So please understand this is about the valuation area, they can ask you to calculate the group value. Okay. Then if I look at this group, what are the other observation we have which has resulted in this lower performance in the group? Any other observation you have? Based on the numbers given, we have analyzed and we got some idea. Now, apart from that, why your performance of the group is not sufficient? We discussed many reasons. I think one of the other reasons we have to mention is that you bought the land for the hydropower, not for hydropower. You actually bought the land for what? Exactly. Did we do the hotel? No. Did we generate money from the hotel? No. Did we do the hotel and did we generate revenue from the hotel? Yes or no? No. Yeah. So if we are not generating the return from the hotel, so you need to mention and the reason for your lesser performance, one of the reason is the investment in the land and the hotel. We don't know exactly the hotel how much we have invested, right? We believe they have not done the hotel, but they might have invested some money. So the land and the investment you made in the hotel, are they generating a return or no generation of return? Can you write down that? One of the reason for your lesser performance? Investment in the land and the hotel does not generate return. No return. Okay. So that is another observation we have. This company during the last so many years, they bought many companies. Did we observe that? They have bought companies. Now, those companies, are they performing? They bought the companies. They bought a confectionery or the chocolate. They bought a dairy company. They bought a hotel. So, are their performance are good or they are not sufficient? I think the hotel industry, when they mention, their target is to buy what hotels? Exactly. They want to buy the loss-making hotels. So you should know the loss-making hotels obviously must have some reasons of loss-making, right? So if you don't sort it out in a reasonable period, you can't generate much return from the business. You can't generate much return from the business. And more importantly, your overall profitability and the return is not sufficient in the business, overall business. So there are macroeconomic issues which we talked about, like the consumable or the disposable income of the customers are lesser and inflation has gone up. Those are the macro picture that we or you or anybody can't do much about it. But other than that, your business model, because it is exposed to higher fixed overheads, have tendency to make lesser profits or maybe losses. So we need to sort out that. We need to sort out that the high leverage business model. Now can we write down strategies to improve the performance? Strategies to improve the performance. What are strategies? Can we write down? Strategies to improve the performance. What?
Exit from the loss-making businesses.
So what is the loss making business we have? Yeah. So one, yeah, you are right. Your one strategy is exit from loss making businesses. Example maybe the power. But keep in mind, I already mentioned the power generation losses, we need to be very clear. The examiner has not given information in the pre-scene level. The power sector may be having some expenses of the hotel in business what you plan for, or maybe the revenue generation is not sufficient. Since you may sign only with the CEB to supply the certain amount of power, and other power what you are generating may not be used properly. So sometimes you are thinking that it is for hotel business and you are not generating out of it. So if that is the case, you have to sort out that as a restructuring before you sell that or exit out of the power generation. So maybe you need to see restructuring of business model. Restructuring the business model. You need to look at it. Not only that's exit from the business, restructuring the business model. Any other? The hotel industry or restaurant industry may not be earning sufficient return. We calculated the operating return earlier. Hotel industry and business return. Hotel industry is generating only a 7% return. Why do you think the hotel industry must be earning a lesser return? Exactly. So can you write down under the possible reason for lesser revenue or lesser profitability, can you write down lack of tourist arrivals? Because that is a direct link to the tourist, that industry. Lack of tourists. Retail you can't say that, but the hotel industry or the restaurant, franchise restaurant, their profits are not sufficient. Why? The tourist arrivals are lower, very lower. Now only it's picking up, but last year it was not good. So that is one of the main reasons. Now tell me, what are the strategies you have to implement to improve your profitability overall? Yeah, converting fixed overheads to variable nature. What is the example? How can we doing? Rent can be paid, but would there be landlord who would prefer to take like that? Sale, you can do it, but you have to own the land. Cargills outlets are owned by them or somebody else's? Can you sell somebody else's land and lease back? You can't, right? So that is out. So yeah. So you might say that maybe rent negotiation. Rent negotiations, one. What else? Now you need to think outside the box. Do you need 300 outlets? Yeah. The salaries of staff, 5,600 staff, convert fixed component and the variable component. Fixed component and variable component. What else? Sorry? Yeah, so that is separate item, we will come to that. Before that, converting fixed overheads to variable. Can you give some more strategies? Go for debt capital. Are you earning sufficient return for debt holder already? All that time I have been discussing whether this company is earning sufficient return for debt holders.
Investors all of us moving to online sales like it is.
I think that is what I am expecting from all of you all. You are the new generation or younger generation, you can't think that first. First thing is that you don't want to sell your supermarket products by opening 300 branches to 600 branches. When you say 300 branches, you make it 600 branches. Are you going to duplicate your cost? Are you duplicating? Your rent will be double, your staff cost will be double, electricity cost will be double, security cost will be double, all that cost will be double. And depreciation of your premises, equipment, racks, furniture, computer system, all will be double. Do you need to do that continuously? So what is the best thing? Exactly. I think why you are taking so long to tell that. E-commerce, promote. E-commerce promote. Give 10% discount to customers who buy online. Same products you buy. Now if you, whether you go to the supermarket and see the product or not, right, you can buy the products. There are packeted products. Maybe vegetable you may not want to. You want to go and see the vegetables. But do you want to see the packeted products like butter, right, maybe the rice, sugar, dal. Do you want to see that physically? No need. So online sales, I think that is the best way for any business online. And last COVID period, people realized it. So it's easy to target that model.
So what about the outsource the loss-making division, something like that?
You can, but when you say you are outsourcing, what business you are going to outsource? Here you are talking about retail. Maybe you can think of transport costs, we talked about earlier. Maybe transport you might outsource. Rather than you owning the lorries and all that thing, fixed cost, you can convert that fixed cost into variable. When you need the lorry, you hire it. Rather than you buy the lorry and have 5 drivers and then say that they are all fixed cost, whether you have a distribution needed or not, you have to pay the salaries for them and pay the transportation cost. So that fixed cost, actually you have to sort out this fixed cost problem. Because that is a major killing. That's a major killing before going into anything. So think any line. Maybe today we just finished with the pre-scene discussion, but you have another 10 more days or maybe 15 days. All the 15 days think that how do you reduce, and then they have given very clearly the retail, supermarket, read the annual report of Cargill's or something, just get an idea how they are doing to reduce these fixed overheads. Because that is how you can make margin. Because these are now supermarkets, are they selling all their manufactured products or they are buying and selling? Most of the products in supermarkets, they are own products or outside products. Yeah, that means what you are getting. In supermarket, when you sell products, what do you get? You get a margin. So that is the difference between buying price and selling price. If you are manufacturing, do you have more margin? Buying, selling, you get more margin. Exactly. You buy and sell, you get a small margin. When you manufacture, you get more margin. So if you are saying your majority of products are buying and selling, you have a smaller margin. From that smaller margin, you have to cover all your fixed overheads. So what is the alternative you have got? Yeah, producing in-house is not easy to say, but it's difficult to do. I think even the Cargills have gone on that line and started that certain businesses. That's why they Kotmale, they bought it, and then they got the ice cream, Walls ice cream, they bought it, and the biscuit confectionery, they bought it. All they bought it because they manufacture those in-house so that get a higher margin as well as they have a supply continuous. Now what I am asking is, majority of products you can't manufacture. You go to supermarket, how many products you get? Thousands and thousands of products. Are they going to manufacture all 1,000 odd products? Not practical. So how do you increase your margin? So one of the major costs you are incurring is the fixed overheads, which is your outlets, which is your outlets. So you have to try, sorry? Yeah, you agree that I think already they are, right? Already they have. Maybe you can say that further farmer network. You improve the farmer network. You increase the farmer network. You agree the price so that your price is controlled. But your overheads to be reduced. Overheads to reduce. So the e-commerce related area you need to look at seriously. And you can give margin or customer benefit 10% discount without you coming. I am sure the banks did that. Banks promote online banking. Banks don't want you to come to the bank branch. Try much as possible to pay online your payments. Do deposit through that. Transfer the money from the bank online so that you don't incur the fixed overheads. Okay. So somebody now, these are all fixed overhead related. Other than that, strategies to improve the performance. What else? Yeah, that I think already they have started. So you can say that invest in new lands, invest in farmlands, farmlands, you can improve. Okay, so that basically improve your output and a lower cost. Anything else? Strategies to improve your profitability. Yeah, solar panels investment to reduce the electricity cost. Very good. What else?
Accelerate debt is able to give discount and get the money to deposit short-term deposit.
Yeah, debt collection, improve. Debt collection, improve, give discounts. This is your working management area.
Try to reduce operating cycle.
Yeah, reduce the operating cycle. That is basically your debt collection. Reduce the operating cycle mean you give the, you basically collect debtors money faster. Right? But I think supermarket, do you sell the goods on credit or cash? So what is the debtors we have? Yeah, maybe the manufacturing side of it. Right? So not that serious. But you have inventories. Do you need to have inventories? Do you have to have inventories? Do you think all the inventory in the supermarket is bought and kept? Do you think that all the goods in the supermarket is bought and kept here? Display? No. That's what I'm asking. All the goods in the supermarket, do you buy and keep it? Exactly. So please understand that you don't really buy. You don't really buy and keep it. Maybe some products, yes, not all the products. Smaller products, sometimes not very much known brands and all, you buy and keep it. You tell the supplier, you keep the goods here, if it is sold, I will pay you. Right, that's how it happens. So you don't really buy. The inventories are not all you have bought one. But what is in the balance sheet is you have bought one. So you need to see how to improve the inventory management. Inventory management systems to be introduced. Right, or to improve the systems in inventory management. So that your working capital improve. So your cash flows also reduce. Cash flow issue also reduces. But still your model for you to make more money, I think that you need to shift your you need to reduce the cost, fixed cost, that online and electronic media or the electronic transaction have to be improved so that you don't incur the same cost. Then you need to look at the advertising and promotion. Advertising promotion cost. You need to see how to reduce it. Advertising and promotion costs. I am sure like everyone would have seen the TV advertisement and paper advertisements. How many paper advertisements they spend? They spend millions and millions money. Do you need that? So you need to see how to reduce that, and maybe use electronic ways, not in the TV and paper. You need to be, now the messages are coming, social media is active, your generation, especially younger generation, you all are in social media. So I need to advertise through the social media. I don't think any of you all are reading paper daily, morning and evening, how many advertisements are in the paper, right? So the younger generation, the youth is more into the social media, so I promote through that the same sales rather than I do it through the normal media what I am doing, okay. So these are the ways I can improve my profitability. But there is another important issue here, if you really look at it, that is, did you buy or did you finance your long-term investments with long-term funding? Did you invest your long-term assets with long-term funding? How do you identify that? Can you look at the non-current assets of the group? Your non-current assets of the group? Non-current assets of the group, how much? How much? Non-current assets of the group is 18 point? 54 or 54 billion non-current assets. Non-current liability? 18 or 19 billion. Equity? Equity is a long term or short term? Equity is short term or long term? How much equity we have? 28 billion. That you can take the minority also, because that is basically you are funding the total assets. Now you see that your non-current liability and equity is how much? 47 billion. And your non-current asset is how much? So are you funding all your long term with long term funding or short term also? Short term also. Out of your interest bearing loans, debt capital, you have a short term commitment is more or long term commitment is more? I am asking interest bearing borrowing, your short term is higher or long term is higher? How much the short term is? 36. Short term non-current liability, no, interest bearing liability, short term is how much, long term is how much? Short term is 18.5 billion, long term is? Yeah. Now can you tell me, when you are funding a long term assets, when you buy acquisitions, these are long term investment or short term investment? You buying a what you call the hydropower, when you buy the hotel, when you buy the biscuit manufacturing company, dairy manufacturing company, these investments are short term investment or long term investment? Short or long? Long. There is no doubt that's a long term. Those, all the investment you are doing, and you are a growing group, you are buying, and the reason 31st March 2022 you have bought another supermarket. That supermarket is a competitor. You bought it for what purpose? Increase the market share. So if you want to buy the competitor, you are increasing market share. It's a short term investment or long term investment? So all the long term investment should be funded. The investment decision has to be funded by financing decision. Short term or long term? Long term. So if you are going to borrow money, already you have borrowed money, out of your total debt capital, 21 billion you have total debt capital, only 2.9 billion is a long term. Balance 18 billion is a? I think long short you all have a problem. 21 billion is the total debt capital of the group. 2.9 billion is a long term, 18 point something is a short term, and you have invested all long term. Do you realize that your group has matched short term to the long term or long term to long term? Is it a problem? 19 billion, are you able to pay tomorrow? Your interest bearing borrowing 18 point something. If the bank tomorrow tells you, can you please that money tomorrow within 1 year, do you have money to pay? Where the money is? Non-performing and non-current assets. Careful. Non-current assets. So are you able to settle your interest bearing borrowing short term within 1 year? Can you first make a big remark to say that company had not funded long term investments with exactly. Can you write and highlight that? Company has not, or not the company, group has not matched your long term assets with long term liabilities or long term funding. So if you don't do the long term assets with long term funding, what would be the problem? If you don't finance your long term assets with long term funding, what is the problem? Exactly. Not the overtrading. Overtrading is also there, but more than that, if you don't fund your long term assets with long term funding sources, you will get into liquidity problem. Can you write down that? Did this company face the liquidity problem? Are they having a serious liquidity problem? Yes or no? Are they having serious liquidity problem? Somebody say no. To pay 1 rupee, how much money you have? Yeah, now you are just going by the numbers. Come on. Final level, you need to have a sense of it. I told you 1 million rupees salaries I have to pay for salaries. How much I can pay them? My Cargills or whatever supermarket we are talking, the supermarket, they are the salary staff we have to pay. For example, 1 million rupee. They all come to pay, collect the pay, 1 million. How much I can pay? 800,000. Do you have 800,000 cash? Think and answer. I am leaving to you the chartered accountant, future chartered accountants. 1 million to pay, how much really you have liquid money? Only 400,000, not 800,000. 800,000 is including inventory. That means you can give the salaries, some salary cash, some salary you give potato, onion, dal and sugar. Can you do that? Can you accept it? So you are working, I am working there, we will get a salary 50% cash, 50% we get the goods. Are you okay? Yes or no? No, exactly. So please understand, 1 million payment, you have money of 400,000. Are you having a serious working capital problem? I only want you to feel that you are in a serious working capital problem. Are you having? Yes. Actually, in this case, the main problem is working capital problem. So what do? Now we have realized it's a serious problem in the working capital and I have not matched the long term assets with long term funding. So how do I solve that problem? Yeah, one is you can see the strategies, you can write down strategies to reduce the working capital problem. Reduce the working capital problem. What are strategies? Restructure short term loan to long-term loan. Restructure short-term loan to long-term loan. 1. What else? You earlier mentioned debtors collection, reduce inventory or the optimize inventory, not reduce inventory, optimize inventory, increase the payable period. Already you are paying on time the creditors. Actually you don't answer by a theory answer. You have a case now, real case now. Please look at the case and answer. Your examiner doesn't want a theory book answer. He wants a case based answer. So creditors, debtors collection you have to improve. Debtors collection you can improve. Then you can improve your inventory management optimizing. Creditors, are you delaying already payments? Already delay. So you further delay, right? Can you tell that? You can't. Exactly. You need to see equity infusion. Even though your gearing is not that great, right? Your great in the sense your gearing is 44%, but you need to understand that you want to invest long term. Your all the acquisitions, even next one, you are going to plan to invest where? One of the investment you didn't finish, you are going to do it. What is the investment?
Hotel.
Exactly, hotel. That is not still finished. So that hotel investment is a short term investment or long term investment. So how do you finance? How do you finance? Long term funding. So please understand, equity infusion needed. Equity infusion needed. What else? How do you improve your working capital area? How do you improve your cash flows? Sorry?
We are not earning the required rate of equity holders. So we are infusing more equity. So again we have a problem.
You are right. But is that mean that now can we run this company further, group? We forget about debt financing and equity financing. How long you can run this group? You are the CFO. Your quick ratio is 0.4. Can you run it? Long run, can you run it? You think an answer. Can you run? You can't. So what is the way? You need financing. And you need what financing? Short term or long term? That's what we said, a short term loan convert to long term. You can further debt borrowing, you can take it. But are you generating sufficient cash flow to pay them? If you take a debt capital, true that it's a low geared company, you can borrow money. But are you able to pay them on a monthly basis? Are you having enough cash flows? So what do I do? What is the alternative? I need equity financing. So what is that? Right issue. You may be right in terms of saying no return sufficient, but that is, forget about it. When I take any company, is it the profitability or the liquidity is important? You can run a loss-making company for some time. Can you run a liquidity problem company for some time? Loss-making companies are running. Good example, government institution. Sri Lankan Airlines, Electricity Board, Railway Department, all are loss-making. But are they running now? Are they running? You are in Sri Lanka. I am talking to all the students in Sri Lanka, right? Are they running? Yes. Why? How they are running? Even at a loss they are running. How? Treasury is giving cash and they are paying all the staff salaries and all the things and they are running. So please understand that running a loss making company is possible, but you can't do is what? Liquidity problem company. So the equity financing is needed. You have to find that sell idling assets. Sell the idling assets. If you identify idling assets somewhere, you sell it and exit from loss making, not the entities, exit from loss making outlets. Exit from the loss making outlets. Why? How many outlets we have? All 300, are they making profits? Do you just think? Can the 300 outlets making profits? Can't be. If they are making profits, your company must be making thundering profit. So please understand that you need to identify not only loss making entities, loss making outlets. If it is not relevant, close that unit. Okay. So these are some of the strategies you have to do to improve the working capital management. Apart from your debt collection, inventory optimization, all that. But on a bigger picture, you need a long-term funding through equity sources. Short-term loan has to be converted to the long-term nature, and you have to sell the idling assets and exit from the loss-making outlets and the entities. Loss-making entities and the outlets. Okay, these are the important things you need to solve it to get out of that problems of the group. Management buyout mean the management of the company buys the shares of the company. Now, this is a small company or large company?
No, sir, in that case, in that PC, there is a one director say he is going to run the power, he has experience.
Yeah. You are right. There is one director who is an engineer by profession. He says rather than you having it part of the unit of your business, you create a separate company and he has long-term future into wind and solar and all the things. So that's a good thing. So you might think of that. It's not a wrong idea. I was thinking about the supermarket chain you want to buy out because it's a larger group. But if you take the power generation, yes, maybe it's a one choice. So you might be exiting. Actually, that's an exit route. Power generation business is loss making. So you might sell it to the person who knows about it. So you get out of that loss making. Right? That's basically your real option. Abandoning the project, you get out of the business. So what are areas the examiner could be asking? I think already 3 questions answer I have given. 3 questions I have given you answer. One is how to improve profitability. 2, how to improve liquidity. 3, valuation of the group. 3 questions we have discussed. Possible question. These are possible questions. Other than that, area they can be asking in the working capital management. The examiner can go into detail about working capital management each item. Maybe inventory management. Rather than just saying overall working capital management, inventory management. I think one point I missed out is over trading. Somebody mentioned over trading. Actually, over trading mean what? Can anyone explain over trading? Too much inventory? Sorry. What is over trading? Very good. You grow your sales faster without having long-term capital. But this company, are you observing sales are growing faster? Are you seeing any of the segment sales are growing faster? Come on, we have discussed enough. Are they having enough fast growth in the sales? No. But are they having a long-term funding problem? Yeah. So definitely they have the long-term funding problem, but their sales are not growing. But if you really look at it, when I look at the sales of the business, Is it growing faster? No. But when I look at the group point of view over the long period, am I growing in terms of business faster? It's not about last year and current year sales I am talking. When I take the group, are they buying new companies? Are they buying new companies? That means that is another way of growing your business. So you are growing your business, the acquisition strategy. Are you having the acquisition strategy on a long run with a long-term funding sufficiently or not having long-term funding sufficiently? Do you understand what I am trying to say? Normally the overtrading means you grow your business faster without having long-term capital. But here the company is not having sales growth faster. But when you take over the 5-year or whatever longer period, are you buying into more businesses? Are you buying into more businesses? Yes. Are you having sufficient long-term funding? Then is it overtrading nature? Yeah. So can you write down somewhere? As a group, you see that you are growing your businesses, not your sales of one division, growing your overall business of the group. You are trying to increase by doing acquisition without having what? Exactly. So that is one of the key concern we have. Okay. So in summarily, I think we have gone long time. Summarily, what are the areas could be asked in the question? Other than the 3 questions we have discussed, what are possible areas?
Dividend, regarding dividend, because they talk about the dividend.
Not that they have not taken, they have talked about dividend, but are they able to pay dividends? It's that when you look at all the chapters of the syllabus, you may say that these are areas can be tested, but dividend, are they having enough profits to pay dividends? No, so don't worry about dividends. Working capital management, definitely an area, right? Then your foreign currency risk management, is it relevant here? Foreign currency risk management? Not very much, right? They may import some item for the what you call the food businesses, but it's not very much. Interest rate risk management? Yes or no? Up to 31st March 2022, your finance cost you have accounted at the new rates or old rates? So if your interest rates in the market April onwards going to be double or triple, if your loans are all floating interest rate loans, what will happen? If you are even at the lower interest rate environment, are your business model is working? Even at the lower interest rate environment, your business is generating sufficient profits? No. So in April onwards, your interest rates have started increasing double, triple. So if your interest rate of the loans you have taken are short term, are you going to be in trouble? And your majority of your debt capital is a short term or long term? Majority of the debt capital is a short term or long term? Yeah. So when it comes to maturity of the short term loans, you have to pay at the new rates or old rates? So that means that's going to impact your business significantly or not significantly? Last year finance cost is how much for you, group? 3.1 billion at the old rates. If your loans what you have are not fixed, it's all floating, or even if it is not floating, the fixed ones which are maturing in 1 year is majority, that means your 3 billion finance cost will increase significantly or not? Yeah, so that will basically kill your profitability. Assume the 3 billion, your finance cost will become another 3 billion, that is 6 billion. Can you manage your business? Are you having a real problem? Yeah, keep in mind. So the interest rate risk management area can be tested, and you need to sort out your capital immediately. That is the not only short term, long term conversion. You need to understand, if you don't get your equity funding right, you are going to be in trouble, because you can't make money. You can't make money. You can't pay your debt. You can't pay your debt. Okay? So second and third mean? First and second. Now, actually, if you say the areas this case can be relating to is the working capital management, interest rate risk management, and your overall debt management or the capital structure area. Capital structure area and your profitability return making related aspect, that is shareholder perspective. And as I mentioned at the beginning, your framework, stakeholders' objectives, whether they are in conflict, that is your framework of financial management. That can be tested in your question number 3. So if that is tested in question 3, question 1 and 2 will have to be left for the other areas. What are the other area you have? Because valuation area is definitely here. In the question 3 we have talked about valuation area, right? And they can talk about the merger and acquisition. Already they bought a new company, so they can talk on that merger acquisition. So that is all covered in question 3. Question 1 and 2 could be on the your normal dividend based valuation or dividend theories, what you talked about earlier, foreign currency management. Then what else? Your investment appraisal. Okay, and the real option, as you know that last time they asked for real option, so maybe they can touch upon the real option again. So these are the question 1 and 2 possible area. Question 3, in a small advice for your exam, question 1 and 2 is 50 marks, 25 marks each, and you have many parts, so you have a chance of scoring more marks from question 1 and 2. So try to get the maximum marks from the question 1 and 2, try to get, because your question 3 will be a lengthy question, it's a time consuming lengthy question. So my advice generally to students is try the question 1 and 2 first, then move on to question 3. But that doesn't mean that question 1 and 2 you should take 2.5 hours. Your question 1 and 2 should be taking how many hours?
1.5 hours.
Exactly, 1.5 hours. Then you try the balance part. Okay. So please try out many of the examples what you have done up to now in your theory classes, right before the exam, and go through the study pack. If you have not gone through sufficiently, go through the study pack before your exam. You have 2 weeks more, so your time is there reasonable. So try much as possible and make sure you are confident. And I would like to say that be confident when you are going to exam hall. That's important. Even if you have not done enough work, but be confident, because exam hall 3 hours you should be confident enough to answer question rather than being negative. Even if you have done last time exam, got lesser marks, don't worry about it. It's a sunk cost. It's sunk cost. So it's not relevant for your this time paper. So you go as a fresh student, fresh knowledge, and try to get it. Okay. So all the very best, right? So my mobile number, if you want, not 772-857-326. You may ask any question before the exam, provided you send a message, right? Because the office time, I also work in a company, right? So office time I may not be answering your question. So by in the evening, late evening I can answer, provided you send me the text and ask, okay? Rather than just calling. Sometimes the people do that. When you are in the pressure, you call anytime and ask, sir, can you explain me? Sorry, I won't be able to do it during the office hours, but definitely after evening I can help you. You have 2 more weeks. Any of the doubts, any of the clarification, please do it before going for the exam. Okay? Thank you very much. For all the very best. Right? Thank you, Charter Institute and the staff involved in this whole thing. I'm sure like there is a certain technical issues we had, but definitely you would have gained something from this discussion. Thank you.